Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of December the 19th, 2016. Now to get started this week we're going to begin where we always do with that all-important US dollar index. We're coming out of the Fed announcement, the economic projections. It leaves me with somewhat of a mixed sentiment as to what the Fed is going to do. Now Janet Yellen, just like 1 year ago, almost to the day, has used that very uncomfortable language of there is no set course. Now, what she means by that, guys, is that the Fed may or may not raise rates, but they're slated to raise rates 3 times in 2017. But again, she has stated there is no set path. That's very dangerous language, and it basically just leaves us right where we've been, right where we were a year ago. So she also talked about this amount of rate hikes in 2015, and in 2016 we didn't get it. We got one. So I don't think that the dollar is going to respond as positive as some might think here, and I think that this could indirectly affect the equity markets here also. So I think that the dollar, while still very strong, I think we are seeing some signs of potential, I wouldn't say weakness, but at least a corrective move, if nothing else. So to outline those critical areas this week, the level we want to watch very closely, the 18-day predicted moving average from VantagePoint. I'll check that here. Now, we do have a trend line break, but again, that was after the Fed announcement. The dollar took a big move up 2 days in a row, but then you can see on Friday we just simply stalled. Now, our neural index is still higher, but our strength indicator is already starting to move lower. Now, the position of the predicted MACD, I do like that. The RSI, doesn't look too bad here, but we are moving towards overbought territory. Now, when we've hit swing highs like this before, you can see we've hit a swing high. The neural index was a leading indicator telling us that the market was getting ready to go lower, but we also had that predicted MACD cross to the downside, whereas this time we have it to the upside. So still pointing towards further US dollar strength indisputably, but again, we have to really, the market has to sit back and digest some of the things that the Fed had stated. Now, yes, she was very hawkish, but some of those statements, again, are definitely concerning. So I would look for the dollar more or less to move sideways next week with a still very slight bullish tone. Now, as we go into the equity markets, once again, we've got pretty much what appears to be a top around this 2270, 2280 area. The key vantage point level that we should be watching next week is that, again, that 18-day predicted moving average. But right now, the key number here we've been holding above is 2246, the 8-day predicted moving average. So I'll draw everybody's attention to that so they can see it. We have bounced off that level 3 days in a row. So my concern with this is, again, that if the dollar pulls back, it's going to drag the S&P 500 down with it. And early warning signs of that, we've got our medium term crossing over our long-term predicted difference to the downside. So as the market's moving higher, the vantage point indicators are actually moving lower, suggesting that we may not be going higher. On the equity markets, we also have the neural index that's in agreement with that, and of course our predicted MACD, definitely in overbought territory. RSI, incredibly overbought territory, but we have still managed to move higher. So we're going to watch this one very, very closely. But again, it looks like we've got a top in place here, and if we follow this down to our predicted RSI, we can see that we are clearly losing momentum here. So that's something to watch next week. Now, again, in the S&P 500 more specifically, I think that a lot of people with the Trump election, I think that what they believe is that there's going to be a change in the capital gain tax next year, so they're going to hold on to those long equity positions until after January 1 to take advantage of that. So we'll see how that one plays out, but right now the equities are definitely soft here, guys. As bullish as this looks, there's a number of indicators from VantagePoint that are warning us against that. Now, when we look at the global indices in general, the DAX still pushing higher, but that's on that very, very dovish Mario Draghi and the ECB. The Nikkei also starting to flatten out. We can see here Now, if I covered this chart up and I blacked the Nikkei out and the S&P 500 out so you couldn't see it, you would think that these two charts were exactly the same. And it would be very difficult to distinguish between the Nikkei 225 and the S&P 500. So for our global indice traders here watching this, not only could there be a short on the S&P, there could also be a very good short on the Nikkei. So keep an eye on that one. Now, when we look at our main commodities, oil and gold, big drivers here, what I talked about in last week's Forex Weekly Outlook is that we need a sustained break of the $54 per barrel mark on oil. We poked through there for about, I would say about 25 minutes to an hour on Sunday night. And then we try to get back up above it on Monday, and then oil came back right back to the top of this range that I drew in from last week's Forex Weekly Outlook, kissed that, and then fell again. But we can also assess here that we bounced right off the VantagePoint 18-day predicted moving average 2 days in a row. So I don't think that the rally in oil may be over just yet. And what I've talked about extensively here and with my own direct clients is that oil has actually had a positive correlation to the US dollar index. So the dollar going up, oil going up. So we definitely want to watch that. Our predicted RSI on oil, 58.2. We don't have a huge amount of momentum here. Once again, our medium term crossing over our long term predicted difference on a swing high that basically sent oil lower. After that spike higher, a classic bull trap here as the bulls try and push oil higher and they just get slammed lower. So the key vantage point level for next week, 51.25. Watch that area very closely. If we can stay above that area, oil could go potentially higher, but if we lose that level, oil will resume its very strong downtrend. Now, with gold, I've talked about this one extensively over the last several months, our Brexit high and our Brexit low. Once gold finally broke below there, there's very little reason to be buying gold at the present time. Now, in the first quarter, that could change, but right now we've got a trend line that basically follows along that critical VantagePoint 8-day predicted moving average. I'm going to bring that in so everybody can see it. We've got our swing high here, and we've got our swing high here, drawing a trend line that actually coincides almost exactly with that 8-day predicted moving average. But the real big level here we want to watch, 1170. In my respectful opinion, if we move back to that area, it's a very good selling opportunity next week, but I think it's going to struggle even to get above 1150. We can see that the market's been banging up against this VantagePoint 8-day predicted moving average, and it's unable to reach the 18-day predicted moving average, which again is very, very bearish in my respectful opinion. And I would still look potentially to break below the 1100 mark towards the 1060, 1070 mark before year end. Now, as we come into our main currency pairs, Euro-US, very heavily traded this past few weeks. We can see here our main assessment that we want to first look at is our VantagePoint 8-day and 18-day predicted moving average coming in at 105.36 and 106.03. We can see we've had multiple tests of this particular area, and then after this very good call from VantagePoint, this triple EMA cross to the downside, multiple retests of the 18-day predicted moving average, and then we get pounded lower. That was fully supported by the Neural Index, the predicted MACD, and of course our predicted RSI breaking below the 40 line, all led to a substantial move down in Euro-US. So when we're using predictive indicators like this, very helpful because it gives us an early warning sign. And again, we had multiple days to get into this particular trade with my own direct clients. We have been selling this one heavily for the last couple of weeks. So for next week, 106.03, as long as we're holding below that level, shorts clearly on the table. Our predicted MACD crossing to the downside. Now our predicted RSI a little oversold, so we would look for that corrective move to begin the week. We've closed the past week out at 104.45. I would look for a move towards the 105.36 to reset those short positions. Now, US Swiss franc, the exact same trade as Euro US. Euro US goes down, US Swiss franc goes up. So my only real concern is this spike after the Fed. We really haven't done much since then. So of course that is a concern. 103.50, we need to break 103.50. I've talked about this on Trader Planet for the last several months here, that 104, 105 is the year-end target. We're coming very, very close to that. But you can see this very tight wedge formation we've got. The critical vantage point 18-day predicted EMA coming in at 101.33, excuse me. That's the area we want to watch, and I think we're going to retest down to this area. But this breakout point here of 101.90, 102, we very well could hold above that, and that could be the bottom of the new potential range. So once we know where the bottom is, we then look for the top. So if we come back down here, retest this, we get long, we should probably be looking at somewhere in the 105 to 107 area for the new range top before we get any real significant corrective move. Now, as we move into our other pairs, the pound dollar. Now, the pound dollar, I'm not convinced at this time is going to see the kind of weakness that we're going to see in the euro, the Swiss franc, some of the commodity currencies. I think the British pound is actually has the potential to recover in the first and second quarters of 2017. But right now, we do have that triple EMA cross from VantagePoint 125.38, but the pound dollar fought its way back on Friday from 123.83 all the way up to 124.82. Not bad at all for something that's in a very significant downtrend. So for now, guys, 124.88, 125.43, 125.38. Those are our key upside pivot areas, but our upper trend line right now is coming in at the 127.50. And in my respectful opinion, we are going back to that 127.50 area once this corrective move to the downside completes. Now, our predicted short, medium, and long-term differences are pointing lower, but our predicted MACD has crossed the trigger to the downside, but above the zero line. And our predicted RSI, you can see, is already starting to turn back to the upside. So I would watch that area around 123.50 to 122.80 very closely. Now, if we draw our swing low off of our lower pivot point here, and if I just draw that right across the screen, that's a horrible line, I know. But around 123, 123.20, I would expect this area to hold, and longs are actually reasonable down in that area. Now, as we come into our dollar-yen pair, I'm not I'm not overly optimistic here, guys, that dollar yen has much more upside past 120. Now, 120, basically what we're doing here, just so everybody can see this, we're going to come, well, first of all, we're going to look at those key vantage point levels, 114.30, 116.12, 117.47, those three pivot areas. We've closed at 117.88, but we're 400 pips from the vantage point 18-day predicted EMA at 114.30. So this is a concern. We are definitely becoming overbought based on that and that alone. In the month of November, dollar yen made a 9% gain. Down from here, this vantage point triple EMA cross that took place down around the 103 level, 102. We went all the way up to 118, one of the biggest single moves I've seen in dollar yen in the last probably 5-10 years. And VantagePoint nailed it. I've got to say it was a great call. We can see that there was a lot of congestion around this area right here in this particular area, but ultimately this prevailed. The VantagePoint triple EMA cross prevailed, and we had a huge run to the upside. But once again here, guys, the currencies are notorious for at the end of the year coming back to where they started. So if we look at this from 1 year ago, you can see that we hit this high point right around 120, 121. So I would look for, if dollar yen is going to fail, that's probably where it's going to be. So be very, very cautious with longs up around this area. The interest rate differential absolutely favors the dollar index. There's no question of the dollar in general, it favors it against the yen, against the Swiss franc. But again, be very, very cautious. And what I would rather see is a significant retracement. And when I say retracement, guys, it has nothing to do with Fibonacci or any of this stuff. It's simply we're going going to run out of buyers here. When you have a big move like this, people are going to take, there's going to be significant profit taking, and we just don't want to get caught in that. And if the trigger for dollar yen to move lower will be if the S&P 500 and the Nikkei move lower. The dollar yen has basically a 95% correlation to those two major global indices. So if we see the equity markets crashing, we want to get short dollar yen very quickly. Now, as we come into our main three commodity currencies, starting with USCAD, USCAD I had talked about it in last week's Forex Weekly Outlook it's in my respectful opinion only that oil will fail, which of course it did, and that will ultimately send USCAD higher. So as oil started crashing lower, long started pouring back into the US Canada, dumping out of the shorts there, and again we've had a nice move up here. We've got a crossover in our predicted MACD, but our predicted RSI, I want this thing above 60 here, guys. That's going to tell me that we're going to get into another trending move. Now, case in point, you can see here we've got a break of the 60 area on the predicted RSI combined with a triple EMA cross. We have a very similar situation setting up right here at almost the exact same level where we were back in October here, guys, October 21st. Realistically, that's, you know, only a little over a month ago. So currencies are incredibly repetitive. That's what I love about them. And again, if this can get moving here, the indicators from VantagePoint are warning of a very similar move here. But again, in my respectful opinion, I think that this move, based around this much higher low this time, could take us back up into that yearly price target, year-end target of around the 138 level. Now, I'm not sure we can get all the way to 138 by year-end, but I do think we are going higher here, and the indicators from VantagePoint fully supportive of that. Our predicted short, medium, and long-term differences. Now, when we look at our medium-term crossing our long-term predicted difference here, basically that gave us a 3 to 4 day warning sign that this trend to the downside was losing momentum. When we based out here on the long-term predicted difference, we immediately started to move up, and these are the kind of trades we look for, because these are the easiest trades you'll ever have, guys, because the buyers, after a substantial move to the corrective move to the downside with this triple EMA cross, we now have the same thing in the opposite direction. So if we are going short based on this triple EMA cross, our indicators right here tell us to dump out of that short and reverse and go long. So right now we're starting at that trend, 132.99, the VantagePoint 18-day predicted moving average, followed by 132.64 and 133.07. So essentially between 132.64 and 132.99 is your entry point to start the week for long trades. Now we do want to keep an eye on oil, because again, oil still could spike to the upside, as I've talked about at the beginning of the presentation. So watch oil very closely. Oil up, USCAD down, oil down, USCAD up. That's the play here, guys. Now, when we come into our final two commodity currencies, Aussie US and New Zealand US, first thing I want to point out here is Aussie US and New Zealand US, as I've said over the last couple of weeks, are the only ones that have been able to stay within this Brexit bar. They haven't broken out to the upside or downside, and they've managed to stay in here. Now, it tried to break out here. We again had a few days here, maybe a week. Again, we tried again, and you can see all of this just basically all kinds of signals here that just really went nowhere. And then finally, the main signal crashed. Now, when it crashed, we stopped exactly on that Brexit low bar. Okay, so that basically tells us that the conventional indicators, Fibonacci, Elliott wave, they really didn't carry any weight whatsoever. But the intermarket correlation of the Aussie currency to things like iron ore, gold, silver, that had a huge effect on the direction of this. And when gold plummeted, the Aussie simply could not survive. Our retracement area here was very thin, but what I want to point out here, guys, we're closing below that Brexit bar, which could be very dangerous in a number of different things, because what this could be is what's known as a bear trap. So the bear trap, basically, we see that we're breaking below that Brexit point, finally we're getting below that area, but then all of a sudden it violently reverses the other way. I'm not convinced that's going to happen, but we are closing the week at 73.03. The key vantage point level 74.32. Shorting into that area, guys, that is a very, very reasonable play, but I would allow this one to settle to some degree and let it retrace a little bit back between the 8-day and 18-day predicted moving average between 74.03 and 74.32, where at that time we can revisit this and think about adding our shorts back in. Now, the exact same thing here would apply to New Zealand US. It basically is the same trade. You can see multiple false breakouts here. I'll just go through it again just very quickly. You can see that we tried to break out here. We failed all along here. All is failing here. Then we have a classic lower high. So we didn't come back and retest that Brexit high, and then down it goes. So we hit this, but New Zealand is actually closing below that Brexit low point. So be cautious of a classic bear trap here. Also, so when I bring this up so everybody can see this, I'm just going to zoom this in a little bit here to make sure I'm clear on this. We'll clear this up. You can see that we've closed below that range bar, that Brexit range bar. The critical level here, 71.04, followed by 70.86 and 70.29. Very bearish close at 69.57. But once again, we want to see if we can, there's two plays here. We let it retrace and look to reset our shorts towards the key vantage point level. Or if we can get a big push to the downside, it is possible that this is a breakout play. So if it breaks out to the downside, we zoom our charts out so we can see this. Our next target would be down at the 67 level. That is entirely possible here, guys, entirely. But the critical thing that I'll say here, and I say it to my own direct clients on a regular basis, know your levels. If you know your levels, then trading can be very much simplified, and that's how we really stay consistently profitable, by avoiding some of these traps that are set up throughout the entire market.